I was asked to take a more micro perspective to discuss how firms respond. And I thought it might be helpful for us to actually review what we already knew about how firms responded in the past, because a lot of these things, what was happening right today is actually not new. So I will discuss two effects. One is about the effect of trade barrier or trade liberalization on firms. The other effect, which is is another prominent feature of today's trade war, is uncertainty with public policy. So number one, what do we know about how firms responded to trade barriers, higher trade barriers or reduction of trade barriers? So in a nutshell, it seems the scholar seems to already agree that it's not really about whether U.S. firms gains or Chinese firm gains. It's really about which U.S. firm gains and which U.S. firm loses. In other words, it's very much a redistribution effect, which we heard quite from Professor Odell. So I wanted to first share with you a very interesting article. This is actually looking at how European firms responded when Chinese import in Europe increased. And so essentially the idea there is that firms from Europe or US or more developed countries, they would actually shift to areas where they have more comparative advantage. And for example, the evidence here is that European firms responded to the increase of cheap labor or cheap Chinese imports by increasing their patenting, IT investment, and productivity. So they're shifting to more higher value-added production. And this is in response to trade liberalization, right? So more trade. And then you can infer that now what happens when there's higher trade barrier. Well, so by the way, so here the takeaway seems to be that the firms with higher technology actually benefit from the EU, or you can think about it as more developed countries. They benefit more from trade liberalization than firms with low tech. And then you might try to think about, what if the reverse happens? The trade barrier increases. Then is it the case that low tech firms will gain and high tech firms will lose? This is another very interesting, an old paper, but I thought it's super interesting in light of the topic that we talk about today, which is about U.S. steel makers. They're lobbying for trade barriers. This was a paper in 1996, and the data was from the 70s and 80s. So first of all, so the U.S. steel makers, by the way, just for background, those who lobby tend to be older, less productive, less innovative, less dynamic in the sense that their CEOs maintain long tenure than non-lobbying U.S. steel makers. But then I thought it's more interesting to see what happens once they actually get the protection they wanted. So this is what this paper found. Number one, obviously, those lobbying firms get a bigger jump in their stock price. And we care about jobs. And then there, in this particular context, they cut the jobs and maintain or increase the wages for existing workers. Obviously, increase the wages for top management team. And more dramatically reduce the R&D expense. So at least in this particular context, increasing trade protection appeared to actually protected laggers, yes, dinosaurs, laggers in the industry, and they encourage less than productive activities. So more fundamentally, this goes back to some fundamental theoretical argument about how competition affects, for example, innovation. And I thought this is a very interesting. This is actually not about trade in particular, but is about competition. But trade or tariff, that affects the competition firms would face. So if essentially this is a very dramatic, I thought it is a very interesting results, which is that the level of innovation a firm invests in exhibits a inverted U-shaped relationship. With regard to competition, which is that firms don't invest a lot of firms do not invest a lot in innovation when there's very little competition. It's just no incentive. Life is too comfortable. Or when there's too much competition. That's when firms don't have the resources to go into innovation, right? So how firms will respond, for example, in response to a particular trade deal, probably depends on where we are already on this curve. Right? So it can actually go both ways. And so these are the effects on firms from U.S., EU, some more developed countries. I have another paper which is actually about the effect of anti-dumping petition against China on Chinese exporters. So the other side of the transaction. So what this paper, this is actually also a relatively older paper. And by the way, these tariffs, anti-dumping petitions or retaliation, they're not new. They have been going on for a long time, right? Even before China joined WTO. So what happens here is this is the data from 2006. What happens is that when there was an anti-dumping petition filed against a particular product category produced by Chinese exporters, some of the Chinese exporters will die, they will exit, but they tend to be the less productive type. And those who survive did not seem to be affected much. And they also the direct exporter seems to exit more often than those intermediaries. And then the exporter that only produce the less sophisticated exporters that just produce a single product, they seem to die more frequently than more sophisticated exporters, right? So this is the evidence we have on the other side of the aisle. So just very quickly, a very quick summary here is that it looks like for firms, the effect of changes in trade barrier or trade liberalization on firms the effect seems to be very much about redistribution of resources. And going back to Professor Odell's point, that was about shifting the composition of industries in the economy. But one more thing is here, like, it's not to say that we don't like low-tech firms and let them die, because after all, this is a redistribution of wealth, and there are real people behind those low-tech firms that might be affected negatively by this trade, right? So that's a different set of story about what you do with the workers whose skills were very specialized with the industries that were going to die with trade, for example, right? So those are the redistribution questions that that I thought is definitely important, not only to firms, but definitely to society. And very quickly about the last point about what's the effect of uncertainty of public policy or any public policy on firms. So it seems that, so I have some piece of evidence which again is not about trade, but is about uncertainties, unpredictability in the environment on firms. And it looks like firms will avoid big changes. They will avoid structural changes until they figure out what's going on here. So probably you can hear similar argument on why some firms would want to wait out and see what happens next. And I'll just stop here.